I'm watching something break in real time, and if you're hearing this now, you're ahead of the curve. Not because you're smarter, but because you're early. Early enough to see what the market revealed in the quiet hours before headlines soften it, sanitize it, and sell it back to you as normal volatility. My name doesn't matter. What matters is access and what that access showed while most of the world was asleep. This was not a routine pullback. This was not price discovery. This was a move engineered in the one window where resistance is weakest and perception is easiest to control. In the dead zone between major trading sessions, paper silver didn't drift lower, it was forced down. Fast, deliberate, with intent. When liquidity disappears, price becomes a suggestion, not a truth, and someone took advantage of that. At the exact same time, something far more revealing was happening elsewhere. Physical silver, real metal not contracts, was trading at a dramatically higher price across the globe. Same asset, same metal. Two realities. That divergence is not noise, it's a signal. When paper and physical detach, the screen stops reflecting value and starts reflecting pressure. This is where most people get it wrong. They look at the chart and ask, why did price fall? That's the wrong question. The right question is who needed it lower and why did it have to happen when no one was watching? Markets don't behave like this unless something underneath them is under strain, and strain leaves fingerprints, timing structure, and asymmetry between paper and physical. Over the next chapters, I'm going to show you exactly what those fingerprints look like. We'll walk through the data, the mechanics, and the hidden stress points that explain why this move matters far more than the percentage suggests. No hype, no recycled narratives, just what the market itself is quietly admitting if you know where to look. If you want analysis before the narrative hardens, subscribe now. And if you're watching this market closely, leave a comment with what you're tracking, because what comes next won't be decided by opinions. It will be decided by who still has the metal. To understand why this move mattered, you have to understand where it happened. Markets do not behave the same way at all hours. Liquidity rises and falls throughout the day, and with it, the reliability of price. When participation is deep, price reflects consensus. When participation thins out, price becomes vulnerable to force. There is a narrow window each trading day when liquidity is at its weakest. The overnight bridge between major financial centers. Fewer market makers, fewer institutional counterparties, wider spreads. In that environment, price does not need agreement to move. It only needs pressure. And that makes it the preferred window for anyone who wants movement without resistance. That's why timing matters more than headlines. When size is sold during peak hours, it gets absorbed. When size is sold into a thin book, it cascades. Orders don't meet bids, they fall through gaps. Stops trigger. Algorithms accelerate the move. What looks like panic afterward is often just structure doing what structure does when stressed. Here's the key point: sellers who care about execution do not behave this way. Professional profit-taking is quiet. It's distributed. It minimizes impact. Dumping large size into the weakest part of the trading day guarantees poor pricing, which means price wasn't the goal. Direction was. This distinction separates organic moves from engineered ones. Organic selling reflects a shift in sentiment. Engineered selling reflects urgency. Someone needed the price lower quickly and accepted inefficiency to get it done. Now add the second layer. While paper silver was being pushed lower in the West, physical silver elsewhere was holding firm at a significantly higher level. Demand did not disappear. It relocated. The screen softened, but the metal did not. That divergence tells you this was not a global repricing. It was a localized distortion. When paper weakens but physical refuses to follow the chart, stops being a mirror and starts being a mask. And when that happens, the move you just saw is rarely the end of the story. This is where the story moves beyond charts and into structure, because markets don't fail loudly at first. They fail in relationships between price and time, between promises and delivery. In a healthy commodity market, the future costs more than the present. Storage isn't free. Insurance isn't free. Capital has a cost. That's why futures normally trade above spot. This condition, known as contango, signals abundance. It tells you the system is comfortable delaying delivery. What we're seeing now is the opposite. Spot silver metal available immediately is trading above future contracts. That inversion is called backwardation, and it is never benign. Markets do not enter backwardation casually. It only appears when urgency replaces patience and confidence in future delivery begins to erode. Think about the message embedded in that structure. If waiting were safe, future contracts would be cheaper to buy. Instead, buyers are paying extra to skip the line. They don't want a claim. They want possession. That tells you the market is no longer pricing time as neutral, it's pricing time as risk. This has serious consequences. For short sellers, backwardation turns the exit into a trap. Rolling positions forward costs money instead of earning it. Delivering metal becomes expensive or impossible. Every path out narrows. Time, which is normally your ally, starts working against you. That's why attempts to push the spot price lower matter so much in this environment. They're not about balance, they're about pressure relief. The goal is to restore the appearance of normalcy to convince participants that waiting is safe again. But structure doesn't respond to appearances. Backwardation only resolves when physical availability improves, and it hasn't. The inversion persists because demand for immediate metal still outweighs trust in future supply. This is how paper markets begin to lose authority, not all at once, but quietly. First through spreads, then through delivery behavior, then through confidence. Backwardation isn't a forecast, it's a diagnosis, and the diagnosis hasn't changed. Now let's address the disconnect that makes this impossible to ignore. Because structure alone tells you something is wrong, but price gaps tell you where the system is breaking. At the same moment paper silver was being pushed lower in the West, physical silver elsewhere was trading at a dramatically higher level. Same metal, same specifications. Two different prices separated by a gap large enough to matter. This is not normal volatility, this is a market dislocation. In a functioning global market, those gaps don't last. Arbitrage exists for one reason: to eliminate price differences. If silver is cheaper in one place and more expensive in another, traders buy low, sell high, and the prices converge. That process is fast, mechanical, and relentless. When it doesn't happen, it's not because traders suddenly forgot how to make money. It's because something is preventing the trade. The obstacle isn't knowledge. Everyone sees the gap. The obstacle is access. You cannot arbitrage what you cannot obtain. And when a price difference persists despite obvious profit, the conclusion is unavoidable: the cheaper price is not available in size. This is where paper pricing loses credibility. A price that cannot be transacted at scale is not a price. It's a reference point. The screen may say one thing, but the market is telling you another through behavior. Physical buyers are paying up. They're not negotiating. They're not waiting. They're securing supply. That matters because commodities are not abstract. They are logistical. They live in vaults, warehouses, ships, and delays. When metal cannot move freely from where it's cheap to where it's expensive, the price signal is broken. The arbitrage mechanism stalls, and the market splits into two realities. This is why the overnight move was not just about direction. It was about optics. Lowering the paper price makes the gap look less extreme. It creates the illusion that the system is still aligned. But illusion doesn't move metal. Availability does. And as long as that gap remains open, it will continue pulling physical supply away from where paper pricing dominates and toward where possession is valued more than promises. That flow doesn't reverse easily. Once metal leaves, it doesn't rush back. And that's the part no chart can show you. This is usually where the counterargument shows up, and it deserves to be addressed directly. The skeptical view sounds reasonable on the surface. Silver moved hard to the upside, a pullback followed. Markets do this all the time. Profit-taking is normal. Corrections are healthy. End of story. If that were all this was, the structure would support it. But it doesn't. Normal profit-taking happens where liquidity is deepest, not where it's thinnest. Large players who want to reduce exposure don't choose the weakest hour of the day and accept the worst possible execution. They distribute risk patiently. They let buyers come to them. They don't slam size into an empty book unless speed matters more than price. That alone should make you pause. Then look at the broader context. If this were a genuine risk-off move, it wouldn't be isolated. You would see confirmation elsewhere. Related assets would weaken in unison, correlations would rise. Instead, what we saw was precision. One market, one moment, one direction. That's not sentiment shifting, that's pressure being applied. Now add the physical market back into the equation. In a true correction, demand softens, premiums compress, arbitrage closes gaps. But here, physical buyers kept paying up. The price difference didn't narrow, it held. That tells you demand didn't break. Only the paper representation did. This is where the healthy correction narrative falls apart. Corrections relieve excess, they release tension. What we're seeing instead is tension being displaced. Paper prices bend, physical prices refuse, and the structural signals stay stressed. Backwardation doesn't appear in cooling markets. Persistent geographic premiums don't survive genuine sell-offs. These are not symptoms of excess being wrung out. They are symptoms of imbalance being hidden. Skepticism is healthy, dismissal is not. When timing, structure, and physical behavior all contradict the simple explanation, it's usually because the simple explanation is wrong. Markets can lie temporarily. Structure rarely does. Now we need to talk about pressure because this is where markets stop behaving intuitively. When positions accumulate on one side, price doesn't adjust smoothly. It compresses. And compression always seeks release. Right now, the pressure is not coming from emotion or speculation. It's coming from obligation. Every short contract represents a promise either to deliver metal or to buy the contract back later. As long as supply is loose and structure is normal, those promises are manageable. But when availability tightens and backwardation appears, they become dangerous. This is where time stops being neutral. Each passing session forces decisions. Positions must be rolled hedged or closed. In a healthy market, rolling forward is routine. In a stressed market, it drains capital. Carry becomes a cost. Delivery becomes a problem. Exit paths narrow. That's why aggressive selling appears near key levels. It isn't random, it's defensive. The objective isn't profit, it's delay. Push price lower, trigger, stop, shake confidence, and maybe buy another day. But time only helps if conditions improve. They haven't. Physical demand remains firm. Structural signals stay strained. Every forced dip makes metal cheaper for buyers who aren't price sensitive. Every attempt to suppress price deepens the imbalance. This is the paradox. The actions meant to reduce risk quietly increase it. Selling paper does not create supply. It transfers ownership. And when ownership shifts to holders who don't need to sell, pressure concentrates instead of disperses. This is how squeezes are built not through chaos, but through persistence. One defensive decision after another until the math overwhelms the narrative. Now, step back and look at this from the institutional level because this is where the imbalance becomes unavoidable. Large institutions don't trade emotion. They trade risk models, liquidity assumptions, and contractual obligations. And those systems are not designed to operate under prolonged structural stress. In a normal market, positions can be rolled, hedged, and exited with relative ease. Liquidity smooths the process. Time is an ally. But when structure breaks, when backwardation persists, and physical supply tightens, those assumptions fail. Risk stops being abstract and becomes operational. For a large short holder, the danger isn't just price moving higher, it's uncertainty. You don't know if metal will be available when delivery is required. You don't know if rolling forward will remain affordable. You don't know if the market will allow an orderly exit. That uncertainty forces action, and forced action leaves patterns. This is why price suppression attempts cluster around key levels. It isn't conviction, it's containment. Hold price below critical thresholds and obligations stay manageable. Options expire quietly, time can be bought, but every attempt has a cost. Selling into weak liquidity distorts price while eroding trust. The more visible the intervention, the less authority the screen holds. Participants begin to question whether price still reflects reality. Meanwhile, physical buyers operate on a different timeline. They don't care about weekly closes or option strikes. They care about securing supply. When stress appears, they act not loudly but decisively. Their demand shows up not as volume spikes, but as absence. Metal that doesn't return. This is where asymmetry forms. One side must constantly manage exposure, the other can simply hold. Time works against one and for the other, and once that dynamic takes hold, outcomes are decided by endurance, not opinion. Now we need to address the rumors with discipline because stressed markets generate stories faster than facts. Some are noise, some are signals. The difference lies in whether they align with what the market is already doing. One theory circulating is that price is being pushed lower to defend critical option levels. The logic is straightforward. If price breaks above certain thresholds, hedging flows can accelerate and create a self-reinforcing move. Keeping price contained delays that risk. There's no proof of intent, but the incentives exist and the timing invites scrutiny. Another narrative involves potential delivery delays enabled by legal clauses designed for extraordinary conditions. These clauses are real. They're rarely invoked. But when physical supply tightens and fulfillment becomes uncertain, they stop being abstract. There's no confirmation, but the fact they're being discussed suggests stress is being acknowledged internally. There's also speculation that some producers are withholding supply. Not because output has stopped, but because selling into a distorted market feels premature. Again, unverified, but consistent with persistent premiums and tight availability. Here's the discipline. Rumors don't create stress. They reveal it. They only gain traction when structure is already strained. That's why verified data must remain the anchor. Facts define reality. Rumors add texture, not conclusions. In markets like this, certainty is the enemy. Blind dismissal is just as dangerous as blind belief. The truth rarely announces itself. It emerges through behavior quietly, persistently, long before headlines catch up. Now we reach the point where observation turns into preparation, because this is where indecision becomes costly. When markets enter this phase, the question is no longer what happened. It's what breaks first. There are a few signals that matter more than everything else combined. The first is whether key price levels can hold through a full weekly close. Not intraday spikes, not momentary breaches. Closes. That's where pressure reveals itself. If price repeatedly pushes higher and refuses to stay suppressed, it tells you effort is increasing while effectiveness is declining. The second signal is the behavior of physical premiums. If those premiums remain elevated or expand, it means real buyers are not reacting to paper weakness. They're treating it as opportunity. That dynamic is critical because once physical demand becomes detached from screen price suppression, loses leverage. The third signal is structure. Backwardation doesn't need to explode to matter. It just needs to persist. Persistence tells you confidence has not returned. It tells you the market still prefers immediacy over promises. And as long as that preference remains, stress accumulates quietly. This is where many participants make a mistake. They wait for a dramatic event, a headline, a failure, a visible crack. But markets rarely give you that courtesy. They deteriorate gradually, then reprice suddenly. By the time confirmation arrives, positioning is already crowded and options are gone. Preparation in this phase is not about prediction. It's about alignment. Knowing which signals matter, knowing which ones don't, and knowing that volatility is not the enemy, misinterpretation is. Nothing about this environment rewards impatience, but it punishes complacency. And the longer these conditions persist, the more asymmetric the next move becomes. The market doesn't need to announce what it's going to do next. It's already telling you if you're watching the right things. This is where reaction gives way to strategy. Moments like this don't reward excitement, they reward clarity. When paper prices drift away from physical reality, the outcome isn't decided by a headline. It's decided by who understands the difference between price and availability. The first lesson is uncomfortable, but essential. Screens can mislead. Not forever, but long enough to shake out anyone who treats price as truth without context. When liquidity thins and structure bends, price becomes a tool, not a signal. The answer isn't to ignore price, it's to interpret it alongside behavior. The second lesson is about time. Volatility compresses decisions. You don't get endless chances to position calmly once pressure resolves. That's why patience matters now, not passive waiting, but disciplined observation. Closes matter more than spikes. Spreads matter more than commentary. Physical behavior matters more than narratives. The third lesson is asymmetry. When one side must act and the other can wait, time favors the patient. Ownership shifts quietly before repricing happens loudly. By the time consensus forms, the opportunity is usually gone. My approach stays simple. I don't chase emotion, I don't panic during manufactured weakness. I watch structure, availability, and the persistence. When those align, the market eventually reveals itself. If you take one thing from this analysis, let it be, this markets don't break when everyone is watching. They break when most people are distracted. The clues appear early, disguised as noise and dismissed as anomalies. If this helped you see more clearly, subscribe so you don't miss what comes next. Share this with anyone who still believes price alone tells the story, and leave a comment with the signals you're watching, because insight always forms before consensus. Stay disciplined, stay patient. Availability always wins.